Thank you so much, Jordan. It is weird having two Jordans. So it's great to be here with everyone tonight. If like Jordan said, if you guys were on, I think it was June last year. Maybe I was on here last time. So welcome back. If so, for those of you that were here, if any, you may remember that one of the main things I spoke about last year was how apartment demand had really kind of cratered, but rent growth was still going crazy. And we were sort of all waiting for the second shoe to drop on that in terms of sort of what was going on from a multifamily perspective. And that's certainly something that has been a major development this year so far. So I'm just going to kind of go through, like Jordan said, for about half an hour or so, just a fairly high level look at kind of some major data points, just trying to give you as much of a broad look as possible while still making it, detailed enough to be useful for you. And then we'll save some time at the end for a Q&A. One thing that's always kind of hard about these is, you might have like a very specific question about like a street corner in a submarket somewhere that I'm not going to know off the top of my head anything useful to tell you. So I will not hesitate to point you to my email address for questions like that. Also at the top of this, I do like to point out at our website, alndata.com/market reviews, we have complimentary market data reports on over, I think, 180 markets now. So if you are interested in a specific market, definitely check those out. Like I said, it's free information. And with that, I'm going to go ahead and jump in. I put the multifamily roller coaster because, as we all know, in multifamily the last few years, where the pandemic in 21, the recovery in the pandemic in 20, the recovery in 21, and then kind of the craziness since, we really haven't gotten back to the quote unquote normal that we were in sort of in the second half of last decade. So we're going to kind of go through some of this. If I can get this to advance, maybe. There we go. Okay. Some methodology details that are going to be relevant tonight. Mostly ALN tracks all multifamily verticals, but only multifamily. So we don't track single family or office, things like that, multifamily only. And we're basically updating these properties on a 5-week rotation. So it's not like a revenue management software where we're just like pulling it from the software. We're contacting over 18 million units across the country on a 5-week basis to update the data. And then something that I always like to point out on these is the numbers that we're going to be looking at for this whole slide deck are going to be conventional properties of at least 50 units. I know for some of you, you focus on those smaller properties. That subset of property is just really hard to get a monthly update on across all these data points that we're updating properties for. So unfortunately, we do track those properties, but we don't include them in our market data just because it kind of muddies up the statistics, if I can talk. So just kind of keep that in mind as we're going through here. We're talking about conventional 50 plus kind of professionally managed tends to be the general demo there. With that, I wanted to just at least give you a little bit of a look at some of the drivers of industry performance and kind of what's going on that front before we jump into the actual multifamily information. So first here, just population growth by year. This is national. One of the big things about 2022 for the multifamily industry is that we actually saw a little bit of a bump in the growth rate in the U.S. population, which hadn't happened in like a decade or a little more than a decade. So you can see that pretty steady downward trend in annual percent change from about 2016 straight through to 2021, and then the bounce back up in 2022. Some of that had to do with more births, and some of it had to do with international migration. But for the first time in about a decade, we saw the rate of population change actually go up. And when we talk about where the population change is occurring, here we're looking at the state level, and this is actually the 2020 through 2022 period. So kind of, and these numbers, by the way, come out from the Census Bureau and it measures from June to June. So you're talking about mid 2020 through mid 2022. And you can see here that in general, when we're talking about population growth, we're talking about Texas and Florida kind of in a class of their own. Just those two states added about 1.4 million new residents in that period. And then when we talk about population losers, you've got California and New York kind of in their own class, both losing over 400,000 people in that period. And then Illinois up there as well, negative 200,000. Most of that is Chicago related. But also one thing I wanted to point out here as well is you can see the lower Atlantic region, sort of North Carolina down, all really strong growers, and you could put Tennessee in there. And then if we did this on a percentage basis and not just numbers, which in a longer presentation is one of the things I would also show here. If you look on a percentage basis, the Mountain West really stands out. So in terms of number of people, it doesn't look as impressive as the lower Atlantic just because the populations in those states tend to be smaller, but really strong growth in that region as well. So another interesting thing that I like to point out is that the Mountain West, Texas, the lower Atlantic, these were the population growth centers before COVID. They continued to be the growth centers during the pandemic, and they've continued that now post-pandemic. So we're talking about really consistent population growth for, at this point, a decade or more in most of these places. And something that I was really paying attention to in the 2022 data was to what extent some of these areas maybe slowed down. I thought, well, there was this big pandemic boom where people were moving to Florida and Texas and leaving California and all this. But in 2022, we've got that in our rearview mirror now. Are we going to see a little bit of a slowdown in some of those areas? And that really didn't materialize. If you look at the 2022 population growth data, 6 of the top 10 counties were in Texas. Florida did really well. Georgia had a couple in there. So really, these are the consistent gainers in terms of population. Okay, so the labor market, you could obviously spend an entire 30 minutes just on this. So I wanted to give you just a couple, again, kind of high level looks at what's going on. The first is just the unemployment rate. You can see, we're down there about 3.7% now. It's been bouncing around the high 3% for the better part of 12 months now. So most of the improvement we saw came in 2020 and into 2021. And if you look at unemployment by sector, just about everything is still in positive territory, even over the last 3 months, which is, the period where we've seen kind of the last 3 to 6 months, we've seen some softening in the labor market, but most of the sectors are still in positive territory, which is a good thing to see. A couple of exceptions. The one major exception is basically the movie industry. The unemployment rate in the movie industry has doubled year over year. It's up over 8% right now. But for the most part, the labor market is still very tight, and that's kind of a double-edged sword because on the one hand, the labor market being so tight is what has allowed consumers to absorb the inflation that we've seen over the last few years and the rent growth that we've seen over the last few years. But also, Fed policy is being determined a lot by these unemployment numbers. And they've been saying for months and months and months that they want to see the unemployment rate get up above 4, even to 5%, to signify that the economy has cooled enough that they can take their foot off the gas in terms of interest rates and other related policies. So the fact that the labor market has stayed this stubbornly tight, again, is positive, but also it is encouraging the Federal Reserve to maybe be more aggressive than they otherwise would be at this point. And the other thing that I wanted to point out too is, and I'm going to reiterate this a few times throughout the presentation tonight because I think it's important. The interplay between employment and inflation is going to have a huge impact on multifamily performance this year. I mean, that's not exactly breaking news, but it bears repeating because as I said, the labor market being tight is kind of keeping the wheels on the economy. We've seen consumer spending stay pretty high, but that's been financed by debt. So we see personal savings going down, household cash balances going down, credit card balances going up. And so that's not ideal, but it's manageable if people are employed. Once the paychecks stop, that becomes a much bigger problem. And that's when you start seeing credit card defaults and car loan defaults and then rent defaults and then it spirals. So the employment picture, keeping an eye on that is going to be important this year. Another just sort of view on that is labor force and labor force participation. So the labor force is now larger than it was going into the pandemic. That happened really in late 2022. So good news there. The bad news, or less good news maybe, is that the participation rate still lags a little bit. It's about 100 basis points lower now than it was in the months preceding when the COVID pandemic really kicked off. So some of that is due to people that retired during the COVID era. People were at retirement age or close and just decided to pack it in. We've seen some reports recently of some of those early retirees coming back into the job market because it does remain a tight labor market and because prices are still high. But for the most part, we would not expect a good chunk of those workers to come back into the job market. And so we may not see the labor force participation rate get back to where it was pre-COVID for some time. We're in the ballpark. And so it's not as though, we've got like a stalled recovery or something like that. The labor force, like I said, from just about any angle has been and remains in pretty good condition at the moment. So inflation, this was a big topic last time I was here. Of course, it's still a relevant topic today. You can see, I was here last summer, so it was about here. And you can see what's happened since. So we've had really steady, significant progress. A couple of things I like to point out with inflation. One is that this is a compounding number, right? So, if inflation is 3%, that's 3% year over year, which means it's 3% higher than last June. Last June was 9% higher than the June before. And so this number compounds. And so we have to remember that even though inflation, the rate of growth is decreasing, prices are still going up, and they're going up even from the levels of the crazy inflation that we saw in 2021 and into 2022. So still a major problem. Again, when people talk about the stickiness of inflation, they're usually referring to how hard it is to actually get inflation back under control, but it can also refer to price stickiness in that, you have a 10% or 20% increase in a price, just because inflation slows down doesn't mean that price is actually going to, revert back in a negative way. It just stops growing, So when we talk about the balance sheets of residents and the pressure that's putting on multifamily demand and rents, that's something that has to be kept in mind. The other thing on inflation is about a third of the CPI number is from the shelter line item specifically. So that's government data that they gather on housing costs, rents, and things like that. And it's not the best data. They're usually a few months behind. It's not super accurate, and so that number is overestimated. If you look on the right-hand side, you can see shelter. They're putting at like 8% year over year. That's higher than it actually is. And in subsequent months here in the next couple of months, as that starts to come out of their data, as they're getting more new months in their data where rent growth has been very low, you'll start to see that shelter number come down. And because that accounts for about a third of total inflation, that inflation number should continue to come down. Other things to point out on the right-hand side, you can see energy and used cars are the big two sort of categories that have seen some negative movement in the last 12 months. But the gainers, transportation services, but shelter, food, new vehicles, apparel. I mean, these are things that people, certainly shelter and food, that people are buying often and consistently, probably apparel too. And so the categories where people are still buying, we're still seeing pretty significant inflation. Okay, so we'll jump into the multifamily data now. Just some quick takeaways though. As I said, the population growth centers in 2022 remained what they were during the COVID period, which generally remained what they were pre-COVID. And the same could be said for the inverse. California continues to lose people. New York continues to lose people. Chicago continues to lose people. Detroit, it tends to be the same markets. And that's been consistent now for 5 to 10 years in a lot of cases. Considerable variance remains at the metro level for labor force participation. I didn't have time to include some actual MSA snapshots of that, but it's worth pointing out that below those national numbers, market to market, there is still pretty wide variance. I would say some of the California markets in particular look very different than a Dallas or a Tampa, something like that. I just talked about the shelter component for inflation. And then again, just that fourth bullet point there, just to reiterate, employment and inflation, the interplay between those two, a big deal for multifamily performance. All right, so we'll jump into the multifamily data. On the left-hand side, annual new units and net absorbed units. You'll notice, pretty consistent tight grouping between those two in the years preceding COVID, and even in 2020, because demand bounced back in the back half of 2020 pretty well. 2021, you see that huge jump up in demand. 2022, the huge drop off in demand. And in that span, new construction continued to ramp up. About 400,000 new units delivered last year, less than 50,000 net absorbed units nationally. And by net absorption, I just mean the net change in the number of leased units from the start of a period to the end of a period. So, if you combine 2021 and 2022, it looks roughly like an average year. And so, a lot of what happened last year was a course correction and just a natural reaction from the market swings that we saw in 2021, a lot of which had to do with policy and, stimulus payments and all kinds of things that were going on that made that a very unusual period of time, economic reopenings and all the rest. On the right-hand side, we're looking just at the first half of the year for the last 5 years. And you'll notice that once again, new construction ramping up this year, even from last year, and demand has fallen even relative to where we were in June of 2022. Now you'll notice that net absorption in June of 2022 was almost 100,000 units, but the year ended at less than 50. The back half of the year, we saw, particularly in the fourth quarter, tens of thousands of units lost in terms of leased units. And so we actually went backwards from where we were at summer. 2023, it remains to be seen if that's going to be the case. I would suspect that we will see some negative net absorption in the fall and winter months. And so we're going to need to see some strong results in the next few months to even really outperform last year, which was obviously a not great year from a demand perspective. What helped in 2022 survive all these new units and almost no net absorption was that average occupancies were, in fact, I'll show you the slide in a second. I'm getting ahead of myself, so hang on. One other way to look at this though, supply and demand. This is monthly new units delivered and monthly net absorbed units. And so you can see in 2021, net absorption was significantly outpacing new supply. And that's when we saw occupancy skyrocketing, rent growth skyrocketing, concessions disappearing. That was that period. Then we saw a little bit of a return to balance. And then in the back half of 2022 to now, it's been the inverse. New supply has outpaced the net absorption for basically 18 months now. And that gap got, you can see, fairly substantial here in the third, fourth quarter of 2022. Now, one sort of red flag, and it's always dangerous to make too much of one data point, but one little blip on the radar was June net absorption actually declined from where we were in May. So we had been seeing a nice spring bounce in demand going into summer. It was the monthly numbers were still low, but we were at least seeing improvement. And then June, we took a step back. So we'll see, as we get to July and August, but generally in a typical year for multifamily, August is about the last month where you get really robust demand, and then we start seeing a cooling off in the fall and into the winter months. So not a great sign to see June kind of take a step back there.
Brendan, quick question. Actually, two questions on this. Is this data that you're going over? Is this true like regionally as well, or are the more populated growth areas different?
I would say that what we've seen regionally is, so I'll say it this way. It's not the case that a few bad markets are dragging down the national number. What we're basically seeing is just about every market is underperforming its historic norm. So the good markets this year relative to other areas are still below where they would have been in like the 17 to 19 period. So it's been a fairly across the board thing, I would say.
Okay. And when you're speaking here on the supply and demand, are these new units, is this new construction or just new units that are, brought to market?
These are new construction units.
Perfect.
Good question. Yeah. So last 24 months, net absorbed units by state. Again, just as with the population growth, obviously not a coincidence there. You've got Texas, Florida, California. The population trends aren't great there, but they have so many people that they can survive it to an extent. But again, really, if you look at the monthly numbers going back to January of 2022, we saw a dramatic shift had occurred from the 2021 just crazy hot demand that we were seeing. There was a little bit of a bump in the summer of 2022, and then it went down again. This year, like I said, we were seeing some good improvement from February, March to April, and then June took a step back. So we haven't really been able to get demand sort of fully out of hibernation after that just explosion in 2021. So what I was about to say a couple of minutes ago is that one thing that helped the industry in 2022, when we had 400,000 new construction units, less than 50,000 net absorbed units, was the occupancy that we got to in 2021 because of the strong demand in 2021. So in 2022, occupancies were declining all year, but they were declining from that peak. And so it wasn't sort of the bloodbath that we might have expected if we started at 91% and then lost 400 basis points in average occupancy. So, national average occupancy peaked a little over 94% in 2021. And now we're, just a hair over 90% nationally. Now, again, it depends on how you present this data. So you could show just stabilized occupancy. So just properties that entered 2023 already stabilized. That average nationally is about 93.5. Okay, so it's not as though every property is got a 10% vacancy rate right now. But what this is showing is the effect of the new units coming into the market. When you take the market as a whole, the overall average is approaching 90%, which is obviously a low number. Going into the pandemic, we were a little over 91%. So this blue shaded region you see here is your average effective rent. That's average collected rent. The gold is average market rent or average asking rent, average advertised rent. So the width of that gold band is basically your lease concession, the difference between the two. You can see lease concessions really started to make a comeback in the fourth quarter of last year and continue to play a role in the market. Rent growth, you can see a little bit of a negative movement here last winter, but then we have seen back into positive territory over the last 6 months. Not much, less than 2%, but we have been in the positive at the national level. About 10 markets or so are negative year to date, but it's not the case that we've seen, dozens of markets going into the negative in terms of year to date rent growth. So again, just trying to give you a little bit below the national number here. Southeast for rent growth, this is again the last 24 months, 25, close to 30% for a lot of those states. See the Mountain West over here as well, fairly high. Again, your population growth centers. Texas managed to lead in population growth and in net absorption, but have a relatively reasonable 19% number over the last 2 years, mostly because Texas always builds a ton of units. So they were building a ton before the pandemic, in the pandemic, after the pandemic. And I should mention too, these rents, this is, and I've got it down there in the fine print, but these rents are for new leases. So we're not able to capture renewal rents. So this is a rent if a prospective resident walks in and says, "Hey, I want to lease your one bedroom. What's the rent?" That's what we're quoting here. So again, substantial rent growth over the last 2 years, especially for those properties that saw significant churn in their residents. Okay, so this just sort of a comparison. We hear a lot about changing affordability in various markets or states and things like that. I'm in Florida now, so I hear it a lot here about how Florida is becoming unlivable and so expensive and all that. So what I did here was I took the state average effective rent at the end of 2019 as a percentage of the U.S. average effective rent at that time. So for example, Florida, 101%, that's basically right at the national average. Right at the national average would be 100%. So Florida was right at the U.S. average. You can see Texas there below average. A lot of these Mountain West states pretty dramatically below average. The lower Atlantic, all below the national average. And then you've got, New York and California really is the big two up there. You've got, Virginia, which those areas around DC, and then Illinois, the Chicago market. So that shows you where we were kind of going into the pandemic. And then the same chart here as of this month. So Texas basically didn't move. You can see California, Illinois, New York came down a little bit, but still the leaders. You can see the Mountain West still below average for the most part, but much closer to the national average. You don't see a lot of 60s and 70s. You're up in the 80s and 90s in terms of the percentage. The lower Atlantic, again, for the most part, below the national average, but closer to the average. Florida went from 101 to 114. So, basically from right at the average to now notably above the average. And so, again, that just shows because when we see the rent growth that we've seen over the last 2 years, when you've got markets that are posting, 25, 30% average effective rent growth for new leases, you have to bear in mind that, yes, that market is getting a lot more expensive in real terms, but in terms of comparisons to other areas, a lot of these areas, because they were also seeing the same level of growth, sort of treaded water. And these really high population growth regions didn't tread water. They did get more expensive relative to the national average, but a lot of them remain below that average. And so, again, you'll see a lot of coverage about, how expensive Charlotte is now to live, or, residents moved to, pick a city in the Southeast, from New York, and they thought it was going to be so cheap. And it is more expensive. And that's a challenge mostly for the residents that were there 5 years ago and haven't been able to keep up with those price gains. But it's also important just to keep in mind that we have to compare region to region, market to market, not just look at one in sort of on its own. Okay, so new construction pipeline, one of the major headlines of this year for sure. We delivered a little over 400,000 new units last year. This year, we're expecting over 500,000 new units to be delivered across the country. The left-hand side, we're looking at the total pipeline here. The ALN is tracking a little more than 5 million total units. To go into that pre-construction category, a project has to be at least planned to break ground in the next 24 months. So we do cap that at 2 years to break ground. The under construction category, these are properties that have already broken ground, but they're not yet leasing. And so those are units that have not hit the market yet, have not started to affect the market yet. But no matter what happens economically, those units are coming online. Whereas, the pre-construction, those can be put on hold, delayed, canceled. We've seen some of that happening with financing terms not working out, given the cost of capital and all of that. So, and then you'll also notice we've got over 600,000 units right now in those two lease up categories. So construction / lease up, meaning they're still completing the property, maybe they're leasing the first phase or the first building, and then lease up, meaning that they're done building and it's just in lease up phase now. So, with the pipeline like that, 1.1 million new units, as we'll see in a slide or two. Average construction times, we would anticipate the majority of those units to be in the market within about 2 years. And so 2023 is going to be a very active year for construction. 2024 is going to be a very active year for construction. And then we may see a little bit of a tail off in 25. And so what that means is that, these new units are definitely necessary. We do still have sort of a long-term housing shortage at a fundamental level. But what that means in the near term is that this is a ton of new units coming online all at one time, most of them in that fairly premium space. And so there is going to be sort of a bumpy ride in a lot of these markets as these units sort of come online and get absorbed and affect their markets. On the right-hand side, we're looking at top 10 markets for under construction units. So again, these are units that are not yet leasing, but they've already broken ground. And you can see, you've got some gateway cities in there, New York, DC, San Francisco there at the bottom, LA, but you've also got a lot of those growth areas, Dallas, Fort Worth, Atlanta, Phoenix, Seattle, Austin, Denver. So It's not entirely true to say that the construction boom that's going on right now is a Sunbelt story, as you can see by these gateway markets that are here. But again, those markets are huge, and so taking the number of units they have under construction just on its own is a little bit misleading, just because those markets are massive, and so they're going to have a ton of new units being built. But some of these areas like Charlotte, Nashville, other regions like other markets like that, smaller markets that relative to their size, their pipelines are even larger. Those tend to be Sunbelt markets where we're expecting some new supply pressure over the next 2 years. So this is total pipeline as a share of existing stock. So not under construction units, but the whole pipeline. And I broke it out into basically these population growth regions. So here's the Lower Atlantic, Texas, the Mountain West, and you can see just massive numbers. Now again, this includes the pre-construction units. So we may see and probably will see some of those winnowing as projects get paused or canceled or whatever else. But just to give you an idea of the scale of what the pipelines are looking like in these areas, this is Florida adding 45% of existing multifamily stock in its current pipeline. So again, this takes a few years to unravel. And so for the rest of 23, certainly into 2024, and then we'll see about 2025 if we start seeing a slowdown or not. But we're going to be in a high delivery environment for at least the next 18 months. Okay, and then so to my point here we're looking at markets. These are under construction units only, and as a percent of existing stock in the market. So Miami up there, over 30% of existing stock represented by the units currently being built there. You can see Boise up there, again, a little over 30%. Vermont, there's no really big metros there, so we have that as the state, same as Montana. You'll notice it about the middle of the chart. But so here again, we're adjusting for size. So you're not just seeing the big gateway markets and all that. These are markets where relative to their size, they have a ton of new units coming online. And so these are markets again where we would anticipate a little bit more turbulence in terms of getting these new units into the market and stabilized. And again, a lot of these markets, whether, Miami, Boise, Fort Myers, Naples, Raleigh, Durham, Nashville, these are all like leaders in population growth over the last few years. And so it's going to be important for these markets that have really been enjoying strong population growth to maintain that growth. And that's why I said when we were looking at the population data that one of the things I was interested to see in the 2022 numbers were what change had there been, if any, because these are the markets where, if suddenly Nashville stops growing so quickly, again, these units have already broken ground, so they're coming online no matter what. That's where you get into a little bit more of a concern. But certainly to the point where we're at now, these high growth markets have really not seen a tail off in that growth. Okay, and then just to wrap up here, one other thing we look at for new construction is the average duration for construction and then the average duration for a lease up. So construction, you can basically see they've moved sort of at an inverse in recent years. So the average construction time, not that long ago was barely more than a year, little under 14 months back there in 2018. It's now up to almost 20 months on average. And again, that can vary widely by market depending on, just what the environment is in terms of regulation and zoning and things like that. But, and then the average lease up duration, encouraging that we haven't seen so far this year a big correction upward. We have seen a little bit of a move up compared to sort of the recent downward trend, but no spike or anything like that. So that's a pretty positive picture in terms of the demand environment that these new units are coming into. I didn't have time to include price class information in this tonight, but from a price class perspective, nationally, the Class A's are doing relatively well. It's really the workforce housing segment, the Class C and definitely the Class D where we've seen the struggle. Class D is negative year to date. We're still seeing household consolidation in those properties. But again, it's going to be some pressure for the next year and a half to 2 years coming from the new construction pipeline. Okay, so main takeaways, rent growth finally has kind of come back down to earth. Last year we still saw a very significant growth in most markets despite the demand picture darkening. This year, because occupancies now have come all the way back down to where they were pre-COVID and then some, we have seen rent growth finally cool off. Again, double-edged sword, obviously, for owners and operators whose costs are still going up. That's not a great thing to see from the perspective of trying to get some balance back in the market for residents that have absorbed $200 a month rent gains in a lot of places. That it's not a terrible thing to see a slowdown there. As I said, national average occupancy is about 100 basis points lower now than it was going into the pandemic. And we've still got 250 to 300,000 new units expected to come online in the back half of this year. And headwinds for apartment demand, again, we're shortish on time, and I could go for a while on this, but we have seasonal trends, right? So apartment demand usually cools off in the winter, fall to winter. So right now we're in the meat of the year for apartment demand, and it hasn't been great. So there's no guarantee we're not going to go backwards in the fall and the winter, which is what we did last year. Also, inflation better, but remains high. There's still a possibility that the Fed will raise interest rates more. They're trying to get unemployment higher because that's their metric for a cooling economy. And so higher unemployment, as I said, means now the people that have been spending money on their credit cards now can't do that and now can't pay those bills perhaps. And so that becomes a little bit more of an issue. And then also student loan repayment, that's due to start up again in October. And that's something where, the rent gains that we've seen over the last couple of years, and a lot of markets, like I said, it's $200 a month, $250 a month. Well, the average student loan payment is somewhere in that range for people that have student loans, $250 to $300 a month by some estimates. So not having that payment for the last 3 years has allowed a lot of residents to absorb those rent gains. Now, when you add back on top the student loan payments to the rents where they're at now, it remains to be seen how that's going to shake out. And so those are some of the concerns. Again, fundamentally though, multifamily is fairly well insulated. I mean, people have to live somewhere, right? And the single family side has its own issues right now with supply, with interest rates, with prices being very sticky on that side. And so it's not sort of a picture of, oh, the sky is falling, but I would say that the sort of bumpy ride that we've been on so far this year and for most of last year is unlikely to be over yet. As I said, we're going to have probably 250,000 new units at least for the rest of the year delivered, which means that we're basically guaranteed to end the year under 90% occupancy nationally, if you include those new properties and not just look at the stabilized only properties. And so it's going to be a little bit of a bumpy ride, but we have to basically at this point look forward to spring of 2023 and hope that we see some demand rebound. And with that, let's open it up to questions.
Awesome. Thank you so much, Jordan. So much good information. This is definitely one I'm going to have to go back and rewatch, as always. So we'll go ahead and open it up to some questions. David, go ahead, unmute yourself, ask your question.
Thank you. Can you hear me okay?
Yeah, we can hear you great.
Excellent. So I got two questions. The first one is, I noticed most of the data that you're presenting in here is really about new construction and impacts of that. With your survey of 18 million units every 5 weeks, do you have the same data for not new construction?
Like renovations?
Well, not renovations, but more current occupancy, current use units, what turn rate is on existing units, and that type of thing.
Gotcha. So turn rates on existing units, no. In terms of occupancies and rents for units eliminating new supply, yes. So we can isolate basically just stabilized properties.
Okay.
So yeah.
Excellent. Thank you. My second question is, how far back does your data go? I mean, you're showing 3 years in most of these slides. Do you have 10, 15, 20-year data? And part of why I'm asking is, it would be very curious to see a long-term trend of things like rent growth, unemployment, occupancy, population percent change, to start to see what some of those long-term trends are.
Yeah, absolutely. So it depends on the market. We've been in business since 1991. So there are a number of markets where we can go back, 30 years at this point. Our newest markets, which would be some of the Northeastern markets and a few of the West Coast markets, we can only go back about 8 years. But yeah, we can go fairly deep on most of the markets in terms of historical trends.
That's
It's always just a matter of what do you try to fit into a 30-minute presentation, but yeah.
Yeah, no doubt. Hey, thank you so much for your presentation, your content. This is just fantastic information.
Sure. Thank you very much.
Awesome. Thanks for the question. That was great. Does anybody else have any questions? I didn't see anything come through the chat yet. If you do have a question, feel free to raise your hand with the reactions button down there at the bottom of your screen. Should look like a little smiley face that you...
While we wait let me just remind people, alandata.com/market reviews if you want some market level complimentary reports.
Yes, and I will say they're great. I use them and they come to my email often, and I love looking through them. So
and we do put stabilized only data on those, by the way, for David.
Yes. All right. And I'm sorry if I butcher your name. Is it Rajendra?
Yeah, Raj. Yeah.
Raj, nice to meet you.
Okay, nice to meet you. Jordan, on your apartment growth that are expected to come in the market, I didn't see Tennessee as one of the major market. Well, I guess there was Nashville, but other than rest of Tennessee, do you have particular regional data showing how many units are expected to come in the market? Or
Yes. So I think the slide that Nashville was on, that was just a top 10 nationally. So it's, there's only so many obviously that can fit in a top 10.
Sure.
But in terms of our data set, yes, we cover every zip code in the US, including Hawaii and Alaska. So we can get like as granular as a census tract or as 30,000 foot as national. So yeah, Chattanooga and some of the smaller, even than that areas of Nashville, we can zoom in on that for sure.
Awesome.
Awesome. Great question. Shanice, go ahead, unmute yourself and ask your question.
Hi, how you guys doing?
Hello.
So my question just was, so would you say that right now wouldn't be a good time to kind of do the market? Or does that kind of just vary to like where you are located?
Yeah, I mean, personally, I would just say like my own view on it is it's less a matter of timing and just it's a matter of like finding the right deal, right? So you can find the right deal no matter what the market is doing. So from a certain perspective, my attitude is like it's always a good time to get in. It's just a matter of finding a deal that makes sense, right? But
Amen.
but yeah, I mean, and honestly, we're in sort of a turbulent period right now, and there's a lot of opportunity in turbulent periods.
Yeah, because I just kind of I just was kind of curious because like you talk to different people, you just dropped a lot of information, and at the same time we have like this controversy where people are saying like, oh, right now is not a good time to buy. Then you're hearing like, okay, well, right now is a great time to buy, especially if you're getting into multifamily. So it's like kind of just like it is definitely true that if you get the right deal, the numbers make sense, but just wanted to kind of clear that.
Yeah, I mean, I think like pretty much any issue in life, right? You're going to find people are going to be very impassioned about the total opposite sides. Like you're going to find like economists are the worst about that. You'll like I literally saw earlier today an article about how there's a massive stock market crash is on the way, and then 2 minutes later an article came by about why the stock market crash has been averted and we're going into a boom. Like you really just have to look at the data, make decisions for yourself, and like I said, in turbulent times, you find the right deal. There's opportunity to be had for sure.
Thank you.
I would definitely agree. I'd just add as well, as you said, a deal can be done in really turbulent times or, really smooth times. It's all about, the data and just, making sure that you have accurate data on what you're projecting, how the market's performing, things like that. So it really just comes back to, the resources that you have and ensuring that you've got that strong, research on the market side as well.
Jordan, one other thing too on that I just thought about is, a lot of the data we looked at tonight, it's multifamily data, it's census data, it's BLS data, publicly available, census and BLS. I created a year or two ago now, like a 25-page report that's behind our paywall for clients, but it's an MSA report. And so you can go into your market and basically see all the multifamily data, but layered on top of the census data. So population trends, jobs trends, like all kinds of stuff like that, like in one report. So that's the kind of thing where if you just want a snapshot of, and you have to zoom in obviously below a market, but just to get an idea of what's going on, rents, occupancies, but also population, jobs, incomes, age of people that live there, things like that. That's a good resource too. I can just maybe plug real quick, but.
I was just there's actually been some questions that came in on the chat about kind of what that resource looks like, how to gain access to it, kind of turnaround time on that. If you have a second, kind of cover what it is that you guys provide and how to get access to that.
Yeah, sure. So we basically provide web-based platforms that also have reports in there for you that we've already created. So it's a subscription basis. And I think, I haven't, the last I knew, like an individual market is like less than $200 a month. It's not super expensive. We have a national platform that's kind of a more sort of Cadillac plan, but the market level stuff is really not all that much. And you can go in, search all the properties in the area, all the management companies in the area. For you guys, it probably wouldn't be as relevant, but like you've got management company and property level contacts. But then we give you like a new construction report, an MSA report, 3 or 4 other reports, all changes. So you get like all the changes that have occurred in a week emailed to you. And so, you can go in and to the question earlier about, getting more granular on it, you can search by like zip code, county, you can search on a map, just zoom in and click, make a little box that you want to, all kinds of stuff. You can search by property type, square footage of floor plans, all kinds of cool stuff. So alndata.com is where you can go for more info on that. We have webinars, like quick little, if you want to just have a look at it. we can get somebody on a Zoom to show you what it looks like. I'm not in sales, so I hope that was a decent elevator pitch. But it's a huge. I mean, really, it's for someone like me. Like I want to be where the data is for what I do for a living, and it's an incredible resource.
Awesome. Thank you so much. Okay, let's go to. I know we're coming up on time, so JR, go ahead.
Hey, Jordan. Thank you again, Jordan. and I'm kind of talking to both of you, but in a sense, to the population growth. Now, what are we talking about? Because I know what you said is correct by having a 15-minute overview, but at the same time, is this on a more secondary, tertiary market, or are we talking about just overall in the state, in that particular state?
Yeah, great question. So a couple of just quick things on that. One, in 2022 specifically, one like subset, like type of city or market that stood out was cities with a university. Saw pretty good population growth as people came back on campus fully. So that was one thing in the sort of like the regional numbers. But in general, and I put this in last year's presentation, I didn't put it in this one, but if you look at the growth states for population, the major metros have grown significantly in the last few years, but also a lot of the secondary and tertiary markets in those states have grown too. So if you look at like population growth as on a percentage basis, which eliminates the problem of just getting the biggest markets in your data set, it's a lot of smaller markets in Texas and Idaho and Florida and North Carolina and Tennessee. So it's really not a story of just the major metros in these states. A lot of the secondary and tertiary markets have seen strong growth as well, particularly if they're within a reasonable distance of one of the larger markets. But it's been pretty widespread.
Thank you so much.
Sure, thank you.
Awesome. Great question. Kimberly, go ahead. Oh, I think you are muted.
Okay, am I good?
Yes, we can hear you.
Okay, thank you. So my question is, in lieu of all of this information, what are the top states that you're seeing the most deals come from right now?
Ooh, I don't have a great answer for you on that.
Okay.
One of the things we don't get very granular on is like transactions regionally. So unfortunately, that one I'm going to have to punt a little bit.
Okay, that's fine. I was just curious because there's a lot of intel, so I was just wondering what that meant for where the deals are coming from at the moment. But that's fine.
Yeah, I mean, I saw something just this morning about, I think it was NMHC that put it out, if I'm not mistaken, the index that they do, and the index for like debt finance, equity finance, transactions overall. It's all like underwater still, but there was a little bit of improvement in transactions. So it seems like there's a little bit of movement happening now. But sorry.
That's okay. Thank you kindly.
Sure.
Awesome. And there was a question that came through the chat. It says, are customers able to customize their data search to fit their criteria as far as property interest using the data? Is there a data tie in areas of high crime as well as the path of progress?
So we don't have a crime filter, but in terms of like you can do by amenity, by floor plan types, things like that. But no, we don't have a crime filter specifically. Although I think that might be something that's in our MSA report. I don't remember off the top of my head, but in terms of a property search, no on that one. But in terms of like very granular geographic units or number of units of the property or age or price class or amenity or number of floors, anything like that, you can slice and dice it however you want.
Perfect. Thank you. And looks like Demetrius, you've got your hand raised. Go ahead and unmute yourself and ask your question.
Yeah. Excuse me. This is recorded. Where do we find these posted later? What folder do we find this in?
Yeah, so it'll be held in the most recent coaching calls in the path. So on your online education, it will be uploaded there roughly 48 hours after we end here.
Okay, my date. Okay, got it.
Yeah, of course.
All right, thank you.
Of course. Perfect. Great questions tonight, guys. I don't see anything else that's come through. Looks like we've got through everybody's hands that were raised. Jordan, do you have anything to leave us with or anything you'd like to add here at the end?
I don't think so. Just, thanks again for the invitation and thanks for the great questions. We have some really good ones. And check out our website again for the free reports and more info on the platforms.
Awesome. Thank you so much for taking the time to hop on here with us and teach us so much about what's going on in the market. And for those of you that missed it, yes, this will be uploaded onto the path under most recent coaching calls. So make sure you go back and rewatch it. I know I'll be going back and rewatching it. And reach out if you need anything. You can reach out to support at themultifamilymindset.com or you can reach out to us coaches at coaching@themultifamilymindset.com. You guys have a wonderful rest of your day and we'll see you next time.